Welcome to The Explainer. Today, we're diving into something we all deal with, but maybe don't really get. It's that financial safety net for our health, our homes, our cars, pretty much everything. We're breaking down the world of insurance.
You know, life is full of curveballs, right? A sudden illness, a fender bender, a storm that damages your house. These are those what-if moments that can totally turn your financial life upside down. So how in the world do you protect yourself from that kind of potential disaster?
Well, the answer is actually surprisingly simple. It's not some complicated modern invention. In fact, it's a concept that people have been using for thousands of years. It really just comes down to sharing the load.
All right, so let's get into the nitty-gritty. How does this whole sharing risk idea actually work? How do you take a huge, scary what-if and shrink it down into a small, predictable payment? Let's take a look.
Okay, so at its very heart, insurance is just a promise. It's a contract. You pay a company a little bit of money on a regular basis, and in return, they promise to help you out financially if something specific and unfortunate happens. You're basically buying peace of mind.
And this is how it all comes together. Think about it. You get a huge group of people, right? They're all facing the same kind of risk, like driving a car. Every single one of them chips in a small amount. That's your premium. All that money goes into one giant pot, a common fund. Now, the magic is, while we don't know exactly who is going to have an accident, we can pretty accurately guess how many will. So that big pot of money is there to pay for the unlucky few who actually need it. It's the law of large numbers, in action, plain and simple.
And get this idea is ancient. We're talking thousands of years ago, Chinese traders were already splitting their cargo across different ships so they wouldn't lose everything if one sank. Or look at the Babylonians. They had a system where loans were forgiven if your shipment got stolen. And modern fire insurance, that was basically born from the ashes of the Great Fire of London. See? It's always been about communities finding smart ways to handle risk together.
Okay, so we've got the how down. But what about the what? What can you actually insure? Well, it turns out the industry basically splits it all into two big buckets.
So here are the two big categories. On one side, you've got life insurance, which is all about protecting people. On the other, you have general insurance, which covers all your stuff. And they have different goals. General insurance is about making you whole again, getting you back to where you were financially before something went wrong. That's a principle called indemnity. Life insurance, though, is different. It's about providing a sum of money to help a family stay financially secure.
So let's zoom in on life insurance for a second. The source material uses this kind of technical term, a human asset. But what does that really mean? It just means that a person's ability to earn an income has a real financial value to their family. So life insurance is all about protecting that value. It provides a financial safety net for the people who depend on you if, God forbid, you pass away or can't work anymore.
And then there's general insurance, which is, well, it's huge. It's everything else. It's the policy that fixes your car after a crash, rebuilds your house after a fire, pays your hospital bills. It can even cover a farmer's crops or livestock. It's all about protecting your property and assets from all those specific things that can go wrong.
Okay, so you've got millions of people, tons of money, and a whole lot of promises. To make sure this system doesn't fall apart and everyone plays fair, you absolutely need a strong rulebook and a referee.
And in a place like India, for example, the insurance industry is definitely not the Wild West. It's built on a foundation of laws that go back decades. As you can see from this chapter outline here, you have things like the Insurance Act and the Consumer Protection Act. These are the rules of the road that all the companies have to follow, covering everything from who gets a license to how they invest the money you pay them.
So who's the main referee? In India, that's the IRDA, the Insurance Regulatory and Development Authority. Think of them as the industry's watchdog. They're the ones who give companies the green light to operate, making sure they're financially solid. But really, their most important job is looking out for you, the person buying the policy.
But even with all these rules and regulators, disputes can happen. What if you have a disagreement with your insurance company? Let's talk about your rights.
This is probably the #1 fear for anyone with insurance, right? You pay your premiums year after year, and then when you actually need it, your claim gets denied. It's a nightmare scenario. But the good news is, you're not on your own. There's an official system in place to help you fight back.
And that's where the insurance ombudsman steps in. So what's an ombudsman? It's basically an independent official whose whole job is to sort out disagreements between you and your insurer. The whole point is to give you a fair shot at resolving your complaint without having to hire lawyers and go through a massive court case.
Yeah, and this quote really nails it. The ombudsman isn't acting like a judge in some scary courtroom. They're more like a mediator, an investigator. They look at all the paperwork from your side and the company's side and then make an impartial call. It's a really powerful way to make sure your side of the story gets heard.
So when you boil it all down, what is insurance? It's a brilliant financial tool that takes a huge, scary, uncertain risk and turns it into a small, predictable, manageable cost. It's a system that lets us plan for a future that is, by its very nature, totally unpredictable. And that leaves me with one final question for you to think about.